Hello everyone, my name is Dinara Azimkulova. I study in Arizona State University and I'm majoring in business administration. Let's imagine that I'm the economic advisor of the US president, and today's topic is the impact of the Ukraine crisis, persisting inflation, and the lingering effects of COVID 19 on the US economy. The Russia Ukraine war won't derail the recovery. The US economy's performance in the past few months has been better than most people expected or even realized. While Omicron took infection rates to a new high, little trace appeared in economic data. Inflation and related problems such as tangled supply chains may continue to challenge business leaders and policymakers, but the US economy is performing well by most measures. The unemployment rate is already back to the full employment level. The labor force participation has started to pick up as some of the folks who left the labor force are coming back to work. Corporate profits are more than satisfactory. Profits in Q3 2021 were 21% above pre-pandemic level. That's much better than many businesses had reason to expect when the pandemic first hit in March 2020. Um, Strong profits have supported business investment. The pandemic shifted investment away from buildings and toward equipment and information products, but the willingness to invest suggests that businesses are surprisingly optimistic about the future. Um, so the pandemic drove the adoption of technology and as a consequence appears to have accelerated labor productivity growth. But just as Omicron's potential impact the economists want, geopolitical tensions increased. The Russian invasion of Ukraine is not likely to derail the US recovery, but it will push up inflation in the short run. The US economy is likely to feel the impact of a continuing Ukraine crisis through two main channels. Um, so, most importantly, the price of oil is likely to remain uh, higher than it would have otherwise, although how much higher is an open question. Russia persists about 12% of global crude supplies. Sanctions may remove some of this oil supply as the United States and possibly some European countries reduce or end purchases of Russian oil. However, oil is a global fungible commodity, and Russia can still sell oil to non-boycotting nations that would release other oil for shipments and boycotting countries without affecting the global price of oil. Of course, payments may be more difficult and Russia may need to sell its oil at discount, but the size of the supply shock may be limited, more limited to 12% figure suggests. Europe's heavy dependence on Russian natural gas suggests that the European economy will experience slower growth or, in the extreme case, a recession. The Europe is a major trading partner of the United States, accounting for more than 15% of US exports. On top of a direct decline in demand, dollar appreciation reflecting the relative safety of the United States will make US goods less competitive. Both would reduce the contribution of exports to US GDP growth. The combined impact is not large enough to generate a recession in the United States, but growth could slow down. Consumer spending. The new the new term outlook for consumer spending turns on two big questions. So the first one is, will consumers spend down all those pandemic era savings? In 2020, during the height of the pandemic, households saved about $1.6 trillion more than before, forecast before the pandemic. When consumer services recover, what happens to durable goods? The second question. The pandemic sparked a remarkable change in consumer spending patterns. Spending on durable consumer goods jumped $103 billion in 2020, while spending on services fell $556 billion during the same period. Housing. The housing central sector has outperformed the broader economy in the wake of the pandemic, as buyers and sellers found ways to navigate the pandemic's restrictions. It has a host of factors combined to boost housing demand over the past year. So the first one is continued strong economic position of high wage remote workers, growing expectations that remote work persist after the pandemic, historically low mortgage rates. And the last one is millennials moving into prime home buying age. Even even as the Fed has reduced its purchase of mortgage-backed securities, demand for houses remains high, and home builder confidence remains above pre-COVID-19 levels. The spread of the Delta and Omicron variants could potentially strengthen the case for remote work, therefore boosting housing demand. More vacant, developed lots of land could be available for home building, driving an uptick in short-term housing supply to meet the strong demand. Business investment. Businesses have ramped up investments since the initial impact of the pandemic, but they have been selective about what they're investing in. Non-residential structures investment continues to be down, more than 20% from the pre-pandemic level. Most likely, the business case for office buildings and retail space collapse with online shopping and its shift over to working at home. Mining structures also took a big hit because of the decline in oil prices earlier in the pandemic. There are signs that construction of mining structures has begun to reverse, which may help to boost the sector temporarily. However, the overall recovery of the non-residential construction is likely to be limited to be continued by the continued low demand for office and trail space. Intellectual property accelerated during the pandemic, and that's mostly because of the investment in software, and likely reflects in the investments needed for telework. We expect that this category to remain strong over the next few years as businesses continue to require software to accompany their investments in information processing equipment. Financing investment should remain easy despite concerns about the Fed raising short-term interest rates. Non-financial businesses are sitting on a pile of cash, and even as the rise, interest rates remain at low levels. Foreign trade. The Ukraine crisis is likely to it's more likely to make things more difficult for US exporters. Lower demand from Europe market for 15% of US exports, and a higher dollar will create some short-term challenges. Beyond the Ukraine crisis, things look more positive. Will real US exports remain substantially below the pre-pandemic level, and real exports are now higher than they were in late 2019. That could translate that into opportunities for the United States as global financial and economic conditions normalize. Um, Over the past few years, many analysts have begun to face the possibility of deglobalization. Global exports grew from 13% of global GDP in 1970 to 34% in 2012. But then the share of exports in global GDP started to fall as globalization began to stall, and opponents of free trade have gained political influence. All this points to an unraveling of the that policies that forecast fostered the earlier globalization. Many businesses have been considering rebuilding the supply chains to create more resilience in the face of unexpected situations such as pandemic, um, and changes in U.S. trade policy. The imperative for such changes has become stronger with the increasing supply chain issues and port delays facing importers of key components and consumer goods. It's impossible, of course, to simply and quickly uh, refashion supply chains to reduce foreign dependence. Um, American companies will continue to source from China in the coming years, but companies will likely accelerate attempts to reduce their dependence on China. Building more robust supply chains may mean moving production back to the United States or perhaps to Mexico or some other closer source. Or it may mean a portfolio of suppliers rather than a single source, even if the single source is the cheapest. So, government policy. President Biden's President Biden Build Back Better plan appears unlikely to pass at this point. But if it does pass, it will likely to be considerably smaller than originally planned. That leaves federal budget policy on a much more modest path than what might have been expected 6 months ago. Um, Labor markets. The conversation about labor markets have switched and fast. Not long ago, employment was about 10 million below the pre-pandemic level, uh, and the main question was how difficult it would be to get all those workers back on the job. Now, business commentary is full of talk about labor shortages and stories about employers struggling to find workers. That seems a bit odd since employment is still lower than the pre pandemic level. Moreover, the economic pictures um, for the immediate future is bleak. Without immediate massive government interventions, several crucial economic problems will only become more perilous for some time ahead. Job growth has already slowed and turned negative at the end of 2020. In large part, businesses have pulled back on hiring because of worries about the uncontrolled pandemic. Massive economic inequality has gone up as more than 8 million people slid uh, into poverty, and wealth inequality rose towards the end of 2020. Scores of small businesses have already permanently closed their doors, and many others are in the brink of failure. State and local governments are financially strapped with a decline of revenue and increasing demand on their services. These problems are widespread and are getting worse. Only the federal government has the uh, wherewithal to boost the economy in order to ensure that this recovery happens quickly and is more effective than the recovery after the Great Recession, which left America's working class behind. Any federal government intervention will have to address three key goals. First, it needs to build up public health infrastructures to combat the pandemic. It needs to offer quick relief to the tens of millions of Americans that are already suffering from or about to face hunger, poverty, eviction, foreclosure, and a lack of health care. And the final one is at the same time, any government intervention will need to make investments in the economy to ensure that robust economic and widespread growth, job growth quickly return.